All right, good afternoon, everyone. Thank you for joining our monthly Move Smartly live market update for February. Let me go through kind of some of the things we're going to be chatting about today, if I can get this to work. So I'm going to chat a little bit about whether Toronto's housing market's heating up. Normally, I kind of kick off with all the latest monthly trends, but I'm going to have some statistics in this section. Just looking at some of the historical trends in the housing market and what we've been seeing sort of the first 6 or so weeks of the year and how that's unfolding and how that might translate into the trends we would expect to see as we move into the spring market. We're going to move on and chat a little bit about sort of what that looks like on the ground if you're buying and selling a home right now. With Gus Papayannou from our brokerage, going to talk about what he's seen with some of his seller clients, what he's seeing with some of his buyer clients. And then we brought on David LaRocque, again, mortgage broker, to chat a little bit about how some of the trends we're seeing on the ground actually in the housing market may in fact be short term. The market, some of the market dynamics and the macroeconomic factors have been shifting. We might see higher rates for longer, and that might change sentiment and change the market. And Dave's going to kind of walk us through some of these dynamics that are changing in the economic environment and how that might impact sort of the market as we move to the year. So the trends we're seeing today, right now in the first few weeks of the year, could very well shift over the next 3-4 months. So moving on to, well, before I do that, of course, if anyone has any specific questions about buying, selling, they can set up a meeting with me. Just go to movesmartly.com/meetjohn, or you can send me an email directly at askjohn@movesmartly.com. So going on to sort of the latest trends in the market, and anyone who's been following myself or other agents on Twitter, where the markets, were pretty active talking about what's happening in real time, you'll probably see a lot of people talking about how the market is competitive and how there are bidding wars and all of these types of stories. And I've been tweeting about it. And interestingly enough, a lot of agents from different markets have been talking about very similar dynamics. So the question is this in fact happening? How do we look at this in terms of the data, and why is it happening? Because if we look at sales for the month of January as an example, sales, for those of you who are watching video, you'll kind of see this chart. Sales in January were at the second lowest level in over 20 years. The red lines, sales are typically around 4,500 per month for the month of January. In 2023, last month, they were just over 3,000. So sales are unbelievably low. And like I said, sort of second lowest. The only lower volume of sales was in January 2009 during the financial crisis. But aside from that, since 2001, this has been the second lowest. So these are not the conditions that one normally thinks of when people talk about the market is busy. And why is it busy? It's not busy in terms of sales. It feels busy on the ground, partly because when we look at the volume of listings that are coming on the market, they are also low, and they are also coincidentally at the second lowest volume for the month of January since 2001, pretty much. So sales are also, so new listings are also soft. And someone asked me on Twitter, and I didn't have a chance to respond or post a thread about it. Well, why new listings matter? And new listings matter a lot because when we think about the balance in the market, it's not just about what demand is doing, right? It's about how are sellers adjusting and what does supply look like. And this, quite frankly, is a dynamic that most people didn't expect. Usually when the market slows down, sales pull back, new listings don't change very much. And then sometimes new listings increase as more people get panicked and worry about the market and want to sell to get ahead of the market. And because new listings usually stay high and sellers are eager to get out, inventory builds up. That's usually how markets slow down. But in Toronto, we haven't seen that over the past 6 or 9 months. New listings have been low. Sellers have been taking their homes off the market. Investors haven't been rushing to sell. and the inventory on the market has been relatively low. And that's why new listings and the balance of the inventory in the market is actually quite important. Now, one thing to keep in mind, and I saw another, I've been seeing so much kind of misinformation online lately. I saw one person post that when we're looking at the housing market, we cannot compare what's going on from 1 week to the next or 1 month to the next. We have to look at things year over year, which is correct in a normal market. In a normal market, we compare January 2023 to January 2022 because there are seasonal differences in terms of the sales volume, new listings volume, prices, all of those things. But when the market's changing and when we're concerned about potential, near-term rapid changes in the market, we need to look at the trends that are going on from 1 week to the next, because they give us clues into what might happen in the future. Just like last year when, people who joined us on our webinars, when the market was turning in February and March, prices were falling $20,000 a week. So if all you're doing, and a lot of agents, what they were doing at the time was just looking at year-over-year trends, and that entire time from February to July, when prices fell 400 grand, prices were actually still up year over year. And this is what a lot of those agents were promoting on their social platforms, that prices were up. Well, from a week over week and month over month basis, prices were trending down. So it's important to look at how the market's shifting, both the speed of the market, the velocity, but also the acceleration. Are we heating up or are we cooling down? And we think about, are we heating up or cooling down? One metric that's very helpful to look at is a metric called the months of inventory, which I talk about, which is basically the number of homes available for sale divided by the number of homes that actually sold in the month. So if 100 homes were available for sale at the end of January and 50 homes sold that month, we would have 2 months of inventory. If only 10 homes sold, we have 10 months of inventory. So this is an important metric because, again, it firstly, it allows us to compare month over month because it's not sensitive to the volume of necessary listings because we've kind of normalized that out. But more importantly, it kind of shows us the direction of the market. And really, we had this spike in inventory, which is very typical in the last 2 weeks of December and the beginning of January. But more importantly, inventory levels have been trending down very rapidly. But even more important is that their months of inventory is actually kind of close to levels that they were at back in August. So we are below what we saw in most of the fall market. So that just means the market's a little bit more tightly supplied now than it was in the fall. And this is actually what a lot of agents are talking about. When we talk about the market being busier right now, we mean it just feels busier. There are more showings, there are more offers on offer nights than we saw in September, October, November. And I'm going to chat a little bit about why this is actually normal for January, but why we didn't expect it later. But this is what we're seeing right now. We're seeing inventory tight, and we can kind of see this by looking at another few metrics over time. This is the percentage of homes that we're selling above the list price. And again, this metric, most people assume it's just about pricing low, and it's not. It's otherwise, if it was, we would never see any change in the metric. Every home will be selling for over asking. And this has been increasing. And last week, it's sort of at its highest level it's been at since July. So the highest number of homes are selling over asking since July. So again, this is a suggestion that the market is slightly heating up a little bit. And again, if we look at this over a longer period, so I'm looking now from 2022 to this past week, and we've seen a lot of volatility. If we look at over a longer time series, there are a lot of peaks and valleys in terms of how many homes are selling for above the list price. So it's not constant. And it usually is an indication of how heated the market is. These big spikes where 80 to 90% of homes sold for above the list price were during sort of the bubbles in 2017 and 2022. So again, these aren't big shifts, but they're slight shifts. And that's kind of what, most people on the ground are noticing. Now, this last one, again, I think is an interesting one, is just looking at the percentage of homes that sold with no conditions. How many people were buying homes with no conditions on them? And similarly, we can kind of see that, when I'm looking at this chart, I'm looking from January 2018 to sort of basically last week. And the stats for February, I should note, of course, are only mid-month stats. But even this metric is at its highest level over the past 4 months, and it's trending up. So more homes are selling with no conditions than they were a month ago or 2 or 3 months ago. And again, these aren't massive movements, but it's certainly a shift of a market that is gradually, a little bit more competitive than it was in the fall market. And I think that's what most agents are observing on the ground. And again, I think a lot of this is due to the fact that inventory is extremely low. I mean, and it's not just, the interesting thing is, I mean, when we think about over asking, it's not always just agents who are pricing low. I mean, last week, a couple of clients of ours were looking at a home at Yonge and St. Clair that was priced at around $2 million, and it was not priced for an offer night. I mean, the listing actually said offers anytime. But within 2 days, 5 people basically bid on it, and the home ended up selling, I think, for 100 grand over asking. But again, I think it's a good, it's a kind of it gives us an indication that there is still a lot of people looking for homes. I mean, interesting, of course, even in this $2 million price point, and they're just waiting for the right home to come on the market to jump on it. Now, just to wrap up, I think it's important to highlight that, and a lot of people don't realize this, that usually the most competitive months in the year in the housing market are usually actually January, February, March. And they're usually the most competitive because this is usually when most buyers start their search. So we have a lot of demand in the market, not necessarily a ton of sales, but a lot of active people. But this is also when new listings and inventory are at their lowest. So it's in a normal year, these are the months usually when we see the most competition on homes, meaning the highest number of offers, say, on offer nights. And usually as we move towards the spring market, the competition eases because tens of thousands of buyers will have bought in the first quarter. So they're out of the market. And we will have had way more listings by the second quarter. That's usually a typical market. Now, so the market's actually behaving kind of normally. I think it caught most people off guard in the real estate industry because we weren't expecting the market to be more competitive. We thought it would be sluggish and slow just based on what was happening, in the fall market. We weren't expecting things to be this competitive. Now, if the market continues to sort of behave normally, that just means that sort of the indicators we're seeing right now on the ground about the market being competitive are not necessarily some long-term shift in the market. And I think this is what some people sometimes misunderstand. This is really just short-term dynamics about what's happening right now. Assuming nothing big changes, we'll probably see the market cool a little bit in terms of the competition. But even bigger than that, and I'm going to let David LaRock, who's a mortgage broker we work actively with, talk about how the macroeconomic conditions could take the market in a very different direction. And I think the key thing to think about now is that I think part of this surge in demand we're seeing, and again, not in sales, demand in terms of activity and the number of buyers out there looking for homes, I think partly has to do with the fact that a lot of people sat on the sidelines for 6 months, waited for prices to fall. Prices since July have been relatively stable, so some buyers just decided to jump in. Rates dipped a little bit, 5-year rates, maybe that motivated some people to jump in. But again, I think these are slight behavioral factors, like some people are just overconfident that the worst is behind us, right? But again, if the news changes and market sentiment changes, that could easily change as we move to the spring market. And I think I just posted actually a tweet from Douglas Porter, who's the chief economist at BMO, who I completely agree with. And he said that we're unlikely to see a lot of pressure on prices in the near term. And we think about how the market is going to evolve as we move to the spring. We are more likely to see new listings rebound versus sales rebounding, right? So again, this is another indicator of why I think things are not going to continue as competitive, because we're probably going to see new listings rebound, partly just because some buyers or some sellers are more confident to list, but also we're going to see an increase in distressed sales, probably. And that will probably bring a little bit more balance. So I don't know if we have any questions, Urmi, before I bring kind of Gus on to chat about some of the latest trends on the ground.
I think you're good to continue with Gus, and
okay, perfect.
Any questions together at the end of your chat.
Awesome. Awesome. Gus, thank you so much for joining us.
Thanks for having me.
Yeah, for sure. So I thought it'd be good to kind of kick off with maybe chatting a little bit about some of your experience that you've seen with your with your seller clients who have listings that they are, that they had on the market and kind of what you've experienced?
Yeah, for sure. I mean, September, October, November, December were fairly sluggish. We're very sluggish. We know that. I mean, it was interesting because listings, there was probably 3 listings that I had that were listed from November onwards or late October, and they took a while. We knew they were going to take a while to sell, and January, we get it January, relisted, refreshed the listing, and all of a sudden we went from maybe 1 or 2 showings a week to one showing, sometimes even 2 showings a day in the first 10 days of January. So we saw activity pick up right away. A couple of the interesting ones that I want to comment on are older condos. I noticed that condos in general are doing well, especially in that $500,000, $600,000, $700,000 price point. These were a couple condos, one in West End, Brampton, and another one in Scarborough in that $600,000 price point, and they're older, well built, really big, like 1,200-1,300 square feet. So there's value there because you have a 2-bedroom plus 10. One of them was even a 3-bedroom, but the fees, $900, $1,000. I believe one of them was $1,100 a month, and that was really holding them back. But still, come January, again, we noticed more people looking at them. We adjusted the strategy, and eventually, they sold. And I think that's been happening with a lot of inventory, where that's stale inventory. And I've noticed it on some freeholds too, where they were just sitting there in October, November, December, but then come first month of January, right in the first couple weeks of January, these homes started selling.
Yeah, that's an interesting story. I mean, can you hear me?
Yeah,
perfect. Yeah, that's an interesting story about your experience. I mean, because when I posted again a lot of these trends on Twitter, and when I did, I think I had some people pushing back on me when I said the market's busier. Some people just are very pessimistic, and it was funny. I mean, at least a couple of people obviously responded to me privately, but one person shared their story, which I thought was interesting because it's very similar to yours. They had a condo listed in November, very few showings. They priced it at market value. They got a number of lowball offers around 10% below market value, or before their list price, what they believe was the market value. So they just basically said, like, after a month and a half or so, let's just take it off the market. We'll relist it in January. And he said when they decided to relist, they were originally going to reduce the price, but then just decided to list it at the same price they were on in November. And he said within 3 days, they had like more than a dozen showings. I think he said 3 offers, like just out of the blue. They didn't price it for an offer night. They were at the exact same prices in November. And he said it sold for 5% over asking. Now, obviously, this isn't the norm, but I think what is the norm is kind of what you're talking about, the fact that there is this renewed interest and more showings and more buyers and all of that stuff on the ground, just looking for stuff that is decent to buy.
Agreed. Yeah, I mean, it's just the perception, the attitude, the could be the new year, could be Bank of Canada's new message, but it just seems that could be frustration. I've noticed that as well. Some buyers couldn't, they've been waiting since the summer to buy, and they finally jumped in. So a combination of all of that.
Yeah. Awesome. And what are you finding from a buyer's perspective, I guess, with your clients as well?
Yeah. Depending what the product is, if it's a condo, I think there's a little more product out there and we can find it. But that's still, the condo market's still very competitive, especially in the $500,000, $600,000, $700,000, $800,000 price point. Freeholds, it's really hard. I mean, especially in prime neighborhoods. I have a few clients looking in prime neighborhoods, like sought after neighborhoods, I should say, whether it's High Park or Yonge and Eglinton or Leslieville, and it just there's not a lot out there, and so the few houses that do come up, we're seeing competition. The ones that are staged properly, the ones that are photographed properly, that are ready to move in turnkey, and then everything else seems to be kind of like that fixer upper. Duplex, triplex that needs quite a bit of work. That is or maybe the home's a little quirky, And those are kind of sitting a lot longer. But the ones that are ready to move in right away, right across Toronto, they're moving fairly quickly, and the activity's good. And we're seeing some bidding wars in some of them. Not everybody's pricing low, but the agents I find in these sought after neighborhoods that are pricing low are getting, whether it's 2 or 3 or 5 or 6 offers. Again, doesn't mean it's selling $200,000 over its value. It's selling in today's value, not February of 22 value. But there's competition.
And you're finding most are, like, in terms of the low rise, are pricing low with an offer night.
Most of the ones that are turnkey, ready to go, staged nicely, which again isn't a lot right now, and I'm tracking like half a dozen neighborhoods from the west side to the east. There's just not a lot, but yes, most of those that are marketed, in a nice way and have that kind of like magazine effect, that really nice look, are. And I mean, I've even seen a couple. Well, I think it was on a freehold and possibly in a condo as well, where it just shows the confidence of the sellers now, where some of them are even saying no preemptive offers, which is kind of crazy. That means basically we will not look at an offer before an offer date, and we saw that on every listing back in a year ago, January, February, but now it's very rare to see. But the fact that I saw it on a couple was surprising.
Yeah, I mean, and just to unpack that a little bit so everyone knows what you're referring to, like a lot of homes in Toronto will have an offer night. They get listed this week, they take offers next week. But usually in the listings, the listing agent will say that the seller is willing to look at preemptive offers. Another name for that is a bully offer. And that's when a buyer comes in with, no conditions, usually a good price. And again, a sign of, usually when buyers do that, they just want the home and don't want to wait till the offer date. Now, when a seller's agent says we won't even look at preemptive offers, it is a sign of like, I don't like overconfidence, because sometimes it's helpful for agents to be open to it because you don't know how many showings you're going to get. You don't know how busy it is. And sometimes that preemptive offer is the best offer if you don't get getting a lot of showings. So that's interesting that some agents won't even look at stuff before their offer night right now. Awesome. Any other kind of observations sort of on the ground that stand out?
Just meeting with new buyers to start the year. I've noticed that, I'm working with a couple and a couple investors, and I've also had a couple phone calls and met with a couple others who want to start their search in March. And they're this is 4 or 5. It could be just me, but it could be a trend. I don't know. We don't know yet, but I'm noticing investors that want to buy smaller price pointed condos, $500,000, $600,000, $700,000 condos, which is not a crazy surprise for Toronto. What is the discussion of, when I break down the numbers for them to kind of help them understand carrying costs and a mortgage and all that, we're negative. We're cash flow negative, probably anywhere between $500 to $700 a month. And the answer across the board has been, we're okay with that for now, because we believe rates will come down. Not necessarily right away within this year. Most of them are in touch with the market, and I think they understand that rates will stay high into 2024. But they're like, hey, if I got to carry it for 12 months and pay the extra $500-600, I can afford to do so. And in a year, 18 months time, that'll change, and I won't be so negative, which is interesting.
Yeah, I agree with you. I've been getting more calls, and like, honestly, I find it amazing. Like, I never would have expected investors to be eager, but you're right. I'm not. I would invest. I'm not jumping because it's like, it's so hard to make the numbers work in this market. But there are a lot of people that are just confident, and you're right. I've heard that as well, that they're not worried about rates because they think we're at the peak and rates are only going to go down from here. And some of them aren't even overly optimistic. They don't think we're going to see massive changes in the next 12 months, but they figure over the next 5 years, the path is going to be down, and they're just fine with it, which is, super interesting. But you're right. The numbers are very, very hard to make work as an investment property anywhere in the GTA, I'd say, even condos, like even if they're small condos, very hard for the numbers to cash flow.
Even with the high rents, which is
Exactly.
we're at all-time highs in rents, which is interesting. So I guess it just speaks to the resilience of the market and the confidence people have the last 20 years and what they think is going to happen over the next X amount of years. It's just
for sure. Awesome. Urmi, do we have any questions before we kind of jump to Dave?
Yes, we do have some good questions coming in. Let's see. Let's start on this. Let's actually follow up. Gus, you were saying about the confidence. You're now seeing a bit of confidence amongst sellers. From Frank Greco, we have the question, are more agents listing at a lower than market listing price today? So I assume that's referring to the practice of trying to elicit or attract multiple offers, like when you price a little bit low?
Yeah, I wouldn't say most. I would say
sorry, are more. Even Frank
more.
went most.
Oh, got it. Yeah,
more agents. Sorry.
Than we saw from April, December of 2022, I'd say, or maybe not April, but summer, the last 6 months of 2022, I would say there's more now. It's still a smaller amount. I mean, if I had to put a number on it, tracking homes in all these neighborhoods, I'd probably say, maybe a third to 40% are putting the offer date. And I think it's important to say, it really depends on the home too, right? Is it tenanted? Can they stage it correctly? Is it presented in a way where it's turnkey ready? Those are generally the homes that are priced low with an offer.
Okay, great. And John, you mentioned that traditionally there tends to be a competitive market in January and February, not the traditional, not the hot markets we think of in the spring and fall that are at the height of activity, but a time when buyers seem to get active before sellers. And this is a bit of a cyclical trend.
Yeah, so the spring has the highest volume of sales, and everyone thinks that's the hottest time. But when we on the ground talk about what's hot, we mean how hard is it to buy a home? How competitive is it? How many offers are on the offer nights, right? In June and January, February are the months where if you just look at a normal year, let's say pre-COVID or whatever, those are the months where you're more likely to see homes with 15 and 20 offers, right? And by the time you hit the spring, homes have 5 offers. So it's still competitive, right? But those first 2 months are usually insane because there's just nothing to look at. So that's why some of these dynamics we're seeing in some ways aren't surprising. They're just surprising because we didn't think it'd be like this given how rates have changed, right?
Okay, so that's actually what I was going to ask. The difference is the rates. This time we were wondering if it would impact regular seasonal cycles, but so far we're seeing something that we would have normally expected. John asks, given so few listings to offer comparables in a market like we're seeing right now, how does the realtor seller establish a fair market value price?
That's a good question. Do you want to start with that and then I'll jump in?
Sure.
Or you want to, it's up to you.
No, yeah, 100%. So it is a great question. In a normal market, I like to go back 3 to 4 months because there's enough comparables and you kind of break down, the nuances, the lot size, the garage, minus the garage, the finishes, the size of the square footage, the street that the home is on, whether it's a quiet street or a busier street, all these little things. In a market like this where there's not a lot of comparables, I do go back. I find, and I've done this recently, where I go back even a year, and then I work backwards. So what taking into effect how much the market has slowed down. If it's a condo, what's the percentage that the market has fallen in condos in that specific neighborhood? I then break it down into neighborhoods, to not just using the average across the board. And it is a little more difficult, but it is doable if you take a wide look and then start to narrow it down to get about a better understanding of finding the same type of condo or the same type of house that sold a year ago at the height, and understanding how much the percentage has fallen in that neighborhood to kind of put two ways of valuing it. One, looking at percentage, how much it's fallen, and 2, the type of house it is and the different types of finishes, and trying to put a value on it that way.
Yeah, that's a great point. And I'm going to add that, right now, it's a little bit easier than when it was in the summer, because prices have been, in the summer, it was brutal because you couldn't go back 3 months because prices had declined. Like if you're looking at buying a home in July, you can't use comparables from 2 months ago because prices are 200 grand lower. So it was actually even harder. At least now prices have been stable for 6 months. And Gus is right. We can go back to the fall market, but he's 100% right as well. Depending on the neighborhoods, that's not even adequate because there just aren't any sales in the fall. And I agree with you that you have to use multiple methods to try to triangulate a value, and you try to pick your best comps from the fall. But I also agree with Gus that sometimes you can go back, and you don't normally do this, but just to inform your decision making, look back like a year and a half ago during a period where prices were roughly where they are today. You know what I mean? And look at what homes are selling for in that range. And it kind of helps you zero in on what is a realistic value. Again, you don't use comps from a year and a half ago, but it helps inform your thinking and your conclusions more than anything.
The more, I find the more you go back and look at, the more you understand. A perfect example is I was looking at a condo townhouse in Liberty Village, and the last 2-bedroom, 1-bath condo townhouse that was 700 to 800 square feet that sold in Liberty Village in that pocket was like 18 months ago. So I went back, 12 months ago and 18 months ago. So I went back and looked at the one that sold 12 months ago, and it was at a very high price. I think the number was something like 900,000. And then I went back further and saw that, 6 months before that, so now we're talking 2020, fall of 2021, it had sold, in the 800,000 or high sevens range. And so you take those two and understand where the market shift happened, sales per square foot, finishes, and tie that all in to kind of get an estimate. It's a lot of work, but it can be done.
Do we have time for one more before we move to David, Urmi?
Yes, we do. So both you and Gus, John, mentioned that you most expect interest rates to remain at the level they're at for the next year. So Adriano Aldini asks, does your team foresee another drop in average prices in 2023? So this year, I know no one has a crystal ball. Thank you, Adriano. We keep stressing we don't, but 1.1 million mortgages are due for renewal this year. 1.1 million mortgages, yes. And the Bank of Canada might bump overnight rate again, its policy rate again. So I think Adriana's question is clear. we keep hearing about the prospect of distress selling or rush to sell.
Yeah, I mean, I'll pull up my crystal ball. I mean, I'll take it. I'll start.
I'll let you lead on this one.
I mean, it's a great question. And again, I mean, I don't do forecasts. I don't make predictions. I think people need to be very cautious about making too many conclusions about how this year is starting. I think, on Twitter where I am, where all you can do is write a tweet. Everyone, I think people draw too much into the fact that the market's starting busy and aren't realizing that and David's going to jump on in the next, just right after I answer this, that there are a lot of economic risks going forward. The market has not absorbed high rates. A lot of the investors I talk to or hear from, a lot of them are just hanging on by a thread, hoping there's going to be some major change in rates, and there probably isn't anytime soon. So is there a possibility that we go towards this deeper recession? And that's the risk is if rates stay high for long is a bigger risk. And quite frankly, going to his question, and if that happens, my bigger concern, quite frankly, is not even this year. It's what does next year look like, right? Because again, I don't think we're going to see anything in the next 6 months. If we see issues, it's going to be towards the tail end of this year, towards the beginning of next year, if rates stay this high, because then people will hit this kind of breaking point. People can hold on when rates are very high and inflation's high for a while, but then just the money runs out, and I think, so I do think there's a risk. I mean, I'm not going to forecast what it is, but I don't think people should take it lightly because these economic conditions aren't changing soon. And in fact, I think if most people I read, and I'm not personally an economist, that the risks are greater, over the next 12 to 18 months. But I think that's why I think for us, it's important to track what's happening, because you start to see these shifts in the market when we look at the data very slowly. It's not like we wake up one day and all of a sudden things change. they're usually pretty gradual. Awesome,
Yeah.
Gus. So did you have anything you want to
Oh,
add?
no, go ahead. No, go ahead. Go
You
ahead.
sure?
Yeah.
Okay, well, in that case, then I'm just going to thank you for joining us today and sharing kind of some of the things that you're seeing on the ground.
Thank you. Thanks,
so
guys.
thank you. And I'm going to ask Mr. LaRocque to join us. So David, for those of you who don't know David, David is a mortgage broker, writes for us at Move Smartly, super knowledgeable, not just about the mortgage market, about macro trends. I mean, I think David's probably one of the few mortgage brokers who reads everything that the Bank of Canada publishes when they publish a note from their financial system reviews to their monetary policy notes. So David has his finger on the pulse of the market, and I wanted to bring David on because a lot has changed even in 2 or 3 weeks. And I remember, I think the last time we did our monthly webinar, it was funny because I think you had published a post that said something along the lines of, what we need to look for going forward is that any good news in the economy is actually bad news or something like that. So I thought it'd be good to kind of bring you on to talk about what some of these good news signs have been recently and why they're actually a slightly bad news story kind of economically and the market. So maybe you can kind of unpack what you've been seeing over the past few weeks.
Sure. Can you hear me okay, John?
Yeah.
Okay. So long story short, for a long time during COVID and in the lead up to where we are now, bad news was good news because bad news meant that central banks were going to have to keep monetary policies looser for longer. The challenge now is the banks want to slow inflation. They want to slow their economies. I'm talking about the Bank of Canada and the Fed, but it's also true of other central banks in developed countries all over the world. Now the challenge is they've cranked up rates and they want to see their economy slow. And insofar as the economies aren't doing that, that means rates have to stay higher for longer, and maybe rates have to go higher. So they've cranked them now. Everybody's wondering when we'll start to cut. But if you're listening to what the central banks are saying, they're saying we may have to raise again. And we want people to be aware that if we have a bias in one direction, it is still towards over-tightening. Because obviously inflation is too high. Their credibility is on the line because they got the transitory call wrong. And ultimately, they see most of the risk still to the upside. Interestingly, John, we had in the past 2 Fridays, we had a banner U.S. employment report. We got 550,000 jobs in the latest U.S. Employment report, which was 3 times the amount expected by the consensus. And then last Friday, we got 150,000 jobs from the Canadian employment report, which was 10 times the estimate. And all of a sudden, the bond markets, which are a bit skittish right now, went from pricing in 2 quarter-point Bank of Canada rate hikes in 2023 to now pricing in a quarter-point increase in July. So when you look at the bond futures market, it's really bouncing around. There's a lot of volatility in the market. You don't want to put too much stock into that as a predictor of the future. But when the market is allowing one employment report to cause it to price out 2 quarter-point cuts and price in a quarter-point hike, you get an idea. By the way, the Bank of Canada has said that it will take an accumulation of evidence. They're pausing now, and they've warned the market not to overreact to individual data points and said that it will take an accumulation of evidence to convince it either that it needs to continue to raise or that rates should fall from here. So that's really the backdrop right now. I think a lot of people were waiting to see where rates would peak and were comfortable getting back into the market once they felt like rates weren't going to go any higher. And I think some of the resurgence we're seeing on the ground in the last few weeks is in part the market buyer psychology was buoyed by the fact that the Bank of Canada had paused, and it looked like people had a pretty good line of sight on rates having peaked. You don't want to buy at 5% if rates go to 8%. You want to, you're more confident getting into the market if you feel like you know where the top is, especially in a rapidly rising rate environment. But as I've said in recent posts, I think the market is getting ahead of itself. I don't think there's I think the market assumes we're going to go back to low rates because that was the normal we got used to for more than a decade. But I think that's folly. I think we're in a new environment. I think if you listen to what the Bank of Canada and the Fed are actually saying, they've got an over-tightening bias. Inflation has proven stickier than expected. A lot of the type of inflation we're getting now is also important to pay attention to. A lot of it was coming from overseas in the beginning. It was in things like good prices. People were buying Peloton bikes to work out at home because they were stuck inside. Now, most of the inflation we're getting in the Canadian economy is coming from service costs. Well, service costs are largely driven by wages, and wages are growing at about 5% and have for the past 7 or 8 months. If wage growth is at 5%, there's no way we're getting back to 2% inflation. And Bank of Canada Governor Tiff Macklem acknowledged that in a speech he made last week. So in reality, if wage growth, which is super sticky and doesn't come down very quickly, is really responsible for a lot of the current pressure that we have on inflation, the bets that we're going to see inflation turn around very quickly and rates fall rapidly lower, to me, seem like pretty aggressive bets. To a point you made earlier, John, and to a question from one of your viewers, it's important to note that when rate hikes happen, the market doesn't change overnight. The Bank of Canada itself estimates that it takes up to 2 years for rate hikes to have their full impact. The first rate hike wasn't until last March. So we're not even a year from the date of the first hike, and we've got to get 2 years in before the impact of that first rate hike it can be fully evaluated in the economy, let alone all the ones that came afterwards. So to your point, John, 2024 is really where a lot of these questions will be answered. And again, I think the market likes quick answers. We're in a very sugar high type information consumption society now. Everybody wants to take the facts on the ground and extrapolate them right away. And the economy just doesn't work that way. Things like rate hikes are slow moving. And market psychology, I think, is getting a bit ahead of itself in terms of imagining, A, that rates have peaked for sure. They may have, but I'm not 100% confident of that. And 2, that they're going to come down quickly. I would say I'm more confident that the market will be wrong about that. Again, no guarantees, but that's my take.
That's interesting. So I want to unpack a few things you touched on because I think it's helpful for people. So one thing important for everyone to remember is that, you know, our variable rate mortgages are driven by the Bank of Canada's rate, but 5-year mortgages are driven by the bond market and bond yields, right? And this is why, for people who are watching our channel, you know, I think even, I can't remember when it was, maybe a few weeks ago, even or like end of January, we had a discussion with Ben Rabideau, and at the time, you know, yields were trending down. There was like some optimism, maybe inflation's under control, and bond yields have dipped, and there's a little bit of optimism that maybe rates will stay lower. And then all of a sudden, I guess to your point, this news of the job market being strong and all of these sort of positive signals economically are kind of leading sort of the bond yields to kind of spike up again. Now, how, like, what is the sort of the shift and the impact do you see on 5-year mortgage rates? Like, even in the past few weeks, like I've seen sort of a lot of comments about 5-year mortgage rates are going to be going up even next week or end of this week. What are you kind of seeing in terms of sort of the 5-year mortgage rate and the impact that these shifts have had on the market?
Well, again, John, to your point, variable rates move in lockstep with whatever the Bank of Canada does with its policy rate, but the bond market moves in response. All fixed rates are priced off of bond yields, specifically most closely Government of Canada bond yields. And those bond yields are thousands of people buying and selling each day based on what they think the future will hold. So bond yields react much more in a much more volatile way, in a much more responsive way. The Bank of Canada is very August, and it says, you know, for example, we're going to pause. We need an accumulation of evidence. So they move with a lot more caution, whereas the bond market can be skittish. And when the Bank of Canada initially said it was going to pause, the bond market sold off and yields dropped by about 30-40 basis points pretty quickly. Anybody you talk to was saying the peak is in, rates are going to fall. Interestingly, right now, you still pay a lot more for a 1 or a 2 year fixed rate versus a a 5-year fixed rate. There's about a 1% premium you pay for short-term money. That's not intuitive. Usually the longer you want to lock in for, the higher the premium you have to pay, because the investor on the other side of that bet is putting their money out for longer, and there's more possibility for risk and for things like inflation to erode returns. Right now, the bond yield curve is inverted, and you pay a lot more for short-term money. Then, John, after the jobs report came out, bond market did a total 180, and now yields have surged 40 basis points higher. So lenders don't react to a 5 or 10 basis point move in the bond market. They try to keep their rates smoother, unlike in the US where things are repriced maybe a couple of times a day. In Canada, lenders operate within a band, and they don't want to change rates every day. But when the market moves this quickly, they have no choice, because their underlying cost of funds is based on those bond yields, is effectively priced on those yields. In answer to your question, lenders are already raising rates, and insofar as the current run-up continues, that will continue to happen. It's crazy. Normally, in a normal market, yields go up a little bit, then they go down a little bit. They're just surging now. It seems like they're either going way down or they're going way up, and the momentum that yields have in either direction is a lot stronger than we're used to seeing. And I think that's a sign of the volatility in the market and the uncertainty.
Yeah, that's a great point. And I think one thing to touch on that that you kind of went over, and maybe you've gone over people's heads, is this idea that you are paying a higher interest rate for a 1 year mortgage compared to a 5-year mortgage is completely backwards. I mean, normally, as David said, the interest rate on short-term mortgages are lower. You pay a little bit more for the security and premium of 5 years. So what we have now is, what you might see in business kind of news networks talked about an inverted yield curve, which is kind of exactly what David's talking about, where the yield or rate on a 5 years is actually lower than 1 year. And usually, a lot of economists you'll read this is typically one of the most consistent and best leading indicators of a recession. I mean, when this happens. I think it's like, I can't remember who I was reading, like statistically, it is like more accurate than any economic forecast. So we are likely to see a recession. I mean, the question, of course, is going to be when and how deep it's going to be. And as we talked about, the longer rates stay high, I suspect is the more pain we're going to see. And as we talked about, it's more likely to be later in the year than kind of over the next 6 months is why I'm kind of what I'm seeing. But
yeah, John, we've got 40% of all the mortgages outstanding in Canada will be renewing between now and the end of 2024. So wow. Just imagine roughly half the mortgage mark will be resetting at these rates. Now, the good news is these borrowers were all stress tested at rates around 5%. And that was when they got their original mortgages. And since most people have 5-year terms, that was 5 years ago on a larger mortgage balance, which has 5 years of pay down built into it this time around. Yeah. So technically we can afford as an economy, consumers can afford for rates to be higher, but there's going to be all kinds of pinching in other areas. And that's the other shoe that we're waiting to see drop, but it hasn't dropped yet. The job market is still strong. Spending is coming in higher than expected. A lot of the economic signals that we see in both the Canadian and the US economy are stronger than expected. Of course, we have to pay attention to the US because as much rigor as we put into what the Bank of Canada says and what Canadian bond yields do, we really do follow US bond yields closely. And I mean, they are the elephant to the south. We import their inflation. They're our biggest trading partner. By far, and in both cases, there's more strength than expected, and that's really what I keep coming back to when I talk about my view that rates will stay higher for longer than the market is pricing in. Even now that it has priced out rate cuts this year, and is pushing them out to next year. And it all comes down to that strength in the economy. We really need to, the central banks have to get inflation under control. And if the economies aren't slowing enough based on current rates, then rates have to go higher. And they are telling anyone who will still listen, that they won't hesitate to do that. The bond market likes to get in a tug of war with the central banks, where they don't always agree, and there's been a tug of war going on right now. And so far the bond market hasn't been listening to the central banks, but it's starting to, and that's the repricing that we see today, is the bond market starting to believe a little bit more what the BOC and the Fed says, as they see these economic data points confirming more strength than was expected.
Yeah. Last thing I'll touch on, I guess, and I don't know if we have any other questions, but one of the reasons, and I'm thinking about this because there's the news about sort of housing starts declining, which I think is an important thing we need to be keeping an eye on. And one of the reasons why it takes time for the market to adjust to rates is that, gradually over time, we're seeing fewer new construction sales, which means new housing starts are going to decline. And housing construction is a massive sector of our economy, right? So if housing starts continue to decline this year, which is very likely to happen, we are going to likely see job losses at the end of the next year or beginning of 2024. And this is where it starts having a bit of a domino effect. And I think, there's a great paper by an economist, Edward Leamer, who actually said housing is the business cycle. And this is kind of what he means. Like when the economy goes into recession, housing starts to slow down, job losses happen, and it has this ripple effect across the economy. And this is why there's oftentimes a lag between these yield inversions and increases. It takes time for that to kind of filter through. So we'll see obviously how all of that unfolds over the next 12 to plus months. I don't know if you had anything else to touch on to wrap up before we take any questions, Urmi.
Oh, yes, we have a lively discussion happening. I'm hearing that maybe trophies should be presented to Dave. That's not a surprise to us. I think that's an appreciation, hopefully. Dave, there's a couple, I think you've touched on already, answering a little bit of Adriano's question around, when we might see enough pressure with mortgage holders to see a drop in average prices. You mentioned that people are stress tested at certain levels. We'll see how long that pressure can be absorbed in the event that rates stay high as expected. Mm-hmm. We're getting questions now about more particular detailed things. Dave, I think they want you to whip out your crystal ball. We have a question here. Variable rate investors are under pressure. Do we lock in short term or gamble on rates starting to come down next year, possibly?
Well, again, that's a tough call. And I'll say what any mortgage broker worth their salt would say, which is that it really depends on the individual, their tolerance for risk, their ability to withstand higher rates, their comfort level in the current environment, because you can't put a price on a good night's sleep. If it were me right now and I was in a variable rate and I was feeling the stress of higher rates, I would be looking at possibly locking in. I don't like a 5-year fixed rate right now. And again, guys, my opinion in $2 will get you a hot cup of coffee. I offer it with great modesty, but I do get asked this question a lot. And after saying that, I would offer my view that 5-year fixed rates to me are still near their peak. And I think there's a good chance they could come down in their second half. If you take a 5-year fixed rate today, I think you have to be very aware of what your penalty looks like if you break the mortgage. Some lenders, particularly the major banks, charge penalties that are 5 times higher than what other lenders charge. If you convert from variable to fixed today and take a 5-year fixed with a major bank, I'm pretty confident that in years 3, 4, and 5, you're probably going to regret that you can't break that mortgage cost efficiently, that the penalty is prohibitive. I think a 3-year fixed rate today is a pretty safe bet. People ask me, where's the middle of the road? What's the safe pick right now? I think fixing for 3 years gives the central banks enough time to bring inflation back under control. Anything less than that looks like an increasingly aggressive bet to me. I like the 3-year time horizon because I think the central banks will get inflation under control, but I'm not confident at what level rates will have to peak for that to happen. I think they'll either have to stay at their current levels for longer than the market expects, or go higher still. And I think if I was in a variable rate right now and I was getting nervous, especially if I was feeling a lot of cash flow strain, you should be able to lock in a 3-year fixed rate today for less than the rate you're paying on your variable. And I think 3 years is a decent amount of protection for whatever comes next.
There you go. That's valuable. Valuable advice from Dave. Dave, another question coming in about when homeowners with existing mortgages are renewing, they will not be stress tested on that, correct? Does that happen at the origination of the mortgage?
So if you're renewing with your current lender and you're doing a straight renewal, you don't have to pass the stress test. You can just sign back the renewal offer and be done with it. But in a slower market, and especially when it comes to renewals, lenders like to play a little footsie with the rate and see if they can get you to sign back something that maybe isn't as competitive as they might have to offer somebody coming through the front door. If you want to move to another lender to take advantage of a better rate, then you have to requalify. By the way, in our industry, we've been pushing back hard against that rule. We don't think it's fair that if you just want to do a straight renewal, you should be basically trapped at your current lender and have to requalify to take advantage of the best deals in the market. It's no surprise that when the regulator consulted with the biggest stakeholders, they decided that that was a good policy for them and recommended that to the regulator. We don't think that's customer friendly at all, and we've been pushing back hard against that. But that's the rule right now. You can renew with your current lender. You have to requalify to go elsewhere. And you should definitely shop around, because I can tell you there's lots of lenders out there. When I see the rates that are being offered to borrowers, I'm a little surprised at how high they are. In fact, I wrote a post called "Have You Passed Your Lender's Laziness Test?" And it's basically saying they're going to offer you a rate that's so high that only the laziest of people would take it. Even a 5-minute phone call can save you a lot of money.
Thanks, Dave. Yes, anyone that reads Move Smartly will know that you've pointed out these really important issues in the industry for a very long time about, the policies that keep big banks sort of in the driver's seat with some of these things. I think we're going to ask one last question. There's a lot today. We won't get to everybody, but we will keep your questions in mind and cover them on another show, so don't be dismayed. I saw an interesting one here from John for you, Dave. Are any mortgage lenders in Canada able to offer home loans similar in renewal term structure to the US model? Are there any benefits to consumers? So first of all, you'd have to explain to us what makes the US model a little bit different and whether that exists here.
Well, the biggest difference is that in the US, most borrowers lock in for 30-year terms. And in answer to your question, we don't have that in Canada. The securitization markets are very different. There's a very complicated explanation for why typically the most competitively priced Canadian mortgages have 5-year terms. You can go out as long as 10 years. At one point, there was even a 15-year option. But because we don't have a very deep securitization market when it comes to longer terms, in addition to paying a term premium for the money being put out there for longer, you also pay effectively a financial market efficiency premium for the fact that there just isn't an active market when it comes to longer terms. So no, we don't have a US model. Every once in a while, the Bank of Canada puts out a paper and basically does a study and talks about the benefits to the market of longer terms. But it doesn't go anywhere. And the long story short is it's not an easy fix. It would be a complicated, we'd basically have to redo our entire mortgage market in order to accommodate those terms. So we look longingly at the US sometimes, especially when rates are rising sharply, and see that they have much more interest rate certainty. But for what it's worth, 5-year fixed rates in Canada are a lot lower than 30-year fixed rates in the US typically. And on average, Canadians have lower mortgage rates. So right now, we might wish we had longer terms, but on an overall basis, our market typically prices pretty well from an efficiency standpoint.
Awesome. So I think that's it for today. We're at 1 o'clock. Thank you, everybody. It was a long segment today, but thank you again, Dave, for joining us and sharing your insights, and Urmi for managing all of our questions and kind of going through them. We'll be back here, of course, next month. If you have any additional questions, please post them in the comments below. We'll try to answer them. You can always send me a question at askjohn@movesmartly.com. Otherwise, we'll see you all next month.
Thank you.
Thanks, John.